Let me welcome on board Mr. Ramaswamy Narayanan, the CMD at GIC RE, joining in on the show right now. Mr. Narayanan, great to have you on ET Now. Thank you so much for taking the time out. The combined ratio for you this quarter was around 110%. Given that there is improvement on a year-on-year basis, what's your target for FY25? Is it going to be around 100%?
No, unfortunately not, though that's something I would love to have. But I think to look at it very practically, I think we would want to be close to the 109 mark because for the entire year last year, we finished at around 112. At that time, the thinking was that we should grow and ensure that our combined becomes better by about 2 or 3%. We've managed that in the first quarter. In fact, in the first quarter, if you compare it with the quarter for the previous year, we actually done very well. But keeping a very practical mind here, I think we would prefer to look at a combined close to 109, 110 for the entire year.
Right. So will a drop in combined ratio be driven by lower claims ratio or improvement in the expenses?
Oh, it will be lower claims ratio. It will be lower expense ratio as well because we are writing a lot of business. In fact, one of the big things that has happened to us going forward is, we have come back on our growth journey now. Earlier, for the last 3, 4 years, we were essentially consolidating our book, trying to weed out loss-making businesses and writing much better businesses. But going forward now, from this year onwards, we'll actually see growth in our book. We plan to grow by about 15, 16% year on year for the current year. So with that growth happening, we would like to also ensure that our combined works well, the loss ratios come down again because the new businesses that we are writing are comparatively much better businesses. The loss ratios are well under control, and we are now able to manage our diversification also. So overall, the book looks good, and we're planning to bring down the combined ratio by both reducing the losses as well as the expenses.
If you look at the industry premium growth for the month of July, it's around 9%. Give us some visibility on what trends you're seeing in the month of July. Will the strong growth momentum sustain?
I think in the insurance market, this is a given. I think if you see over the last few years, the Indian insurance market has been growing double digit year on year. And that has come for various reasons. One, the base was comparatively small earlier because, not many people were taking insurances. But now a lot of people are buying insurance. There's a lot of interest. COVID brought about a sea change in the thinking of people when it came to buying health insurance. People realize that they need to have good health insurance that will be able to take care of their expenses. So with that, you see a growth happening in the market. Again, you see a lot of initiatives by the government as well as the regulator, where they are trying to ensure that the overall insurance coverage goes up. So you would have also heard the regulator coming up with the slogan saying insurance for all by 2047, which means that by 2047, every man on the street must have some kind of insurance. All this is bringing that growth essentially because companies are seeing and they're also getting the benefits of better legal and better regulations by the regulator, which helps them to do the business, and so the growth is happening. So I would typically look at a double digit growth happening in this market year on year for the next few years now.
Okay. So, in terms of the investment income, which was up by 7%, this is largely supported by PAT growth in this quarter. What is your take on that?
So actually, the investment book is doing well. So if you look at our investment book, almost 72, 73% is in fixed income, in debt. About 15, 16% is in equity. About 9% is in money market, and we keep that way so that if any claims come, we do have ready money to pay. With all that, the book is very safe. It is giving us good income. We don't trade in our debt book, so it is held to maturity. So all the rates that we got in the previous year, it's actually locked in well. So honestly, we have tried to kind of ring fence the investment book in such a way that even if there is a rate cut tomorrow, it doesn't really affect our book much. So our motto here is very simple. Whatever risk appetite that we have, whatever risk we want to take, we take it in our business, in the fire and agri and health business that we write. Our investment book is very safe. So, going year on year, you will see this income going up, and it's kind of adding to the profit that we make from our business.
Uh, Most of the insurance companies, something which you answered also, they get money from float, and real operations they don't make money. But the real efficiency is that when you make money from operations, not from float. How do you see that changing for the Indian insurance sector?
Well, you need to understand that different markets work differently. So if you look at some of the foreign markets, yes, they do make underwriting profits, which means that their combined ratio is below 100. In India, it has never happened. I don't think we've ever had a situation where the insurance market has had a combined lower than 100. There are multiple reasons for that. One, the fact that we are a growing market, so you need to ensure that more and more people come into the insurance bracket. So obviously pricing becomes an issue, and there's a lot of pressure on pricing. Second, there are few things that work well in this market. For instance, it is a cash and carry market. Unless you pay the money upfront, the insurance policy is not effective, which means that the money comes to the insurance companies upfront, and the claims happen through the year or maybe later than a year. So that is a big float that is waiting there, and which is earning you income. The investment market is good. We are the yields that we get are comparatively much more better than other markets around the world. So obviously it is a situation where it will continue, I guess, for some more time, where your investment income will continue to kind of buttress your or subsidize your operational results. Now, the point is very simple, and this is what we do. What we do is we try to add the income that we get from our policyholders' funds. So, my overall investment fund, we divide it into two. One is the money that I've got with me simply because of the business I'm doing, and second is my shareholders' funds, which is my net worth on book value basis. So the money that I have from the policyholders, which are my provisions, because motor third party is long tail, so I need to make provisions for that. Agriculture, I make provisions. Property business, I make provisions. So those provisions plus the the premium that I receive upfront, these make up my policyholders funds. The income coming from that, we plow it back into the business. With that investment income, if my overall operations are profitable, I think we are doing a good job. The moment my operational profits become negative, that is when I need to start worrying. That is when I know that my pricing is not proper. That is when I know that my underwriting is not right. So I think this will continue for some more time.
Thank you for being that candid, Mr. Ramaswamy. Good chatting with you today.
Thank you. Thank you for having me.
If you like this video, then like, share and subscribe to ET Now.